What I want to do today is talk about what we saw in the markets in Q1. Predictably, much in the same way as 2022, we saw a lot of volatility. Once again, in the bond market, we saw a lot of that volatility. Some of the analysts are thinking that we haven't seen this level of bond market volatility and this level of sensitivity to interest rates since 2008, since the crash of Lehman Brothers. So we are really getting into times that we've not seen for a very long time. So we're getting into an environment that we've not seen since the last financial crash. In Q1 specifically, January started off very well. Much of the performance drivers that we saw in Q4 were still roaring ahead, which was China, emerging markets, Europe, precious metals, everything that benefited off a weak dollar. And that weak dollar story was very much coming through from the perception that we were done with rate hikes in the US, done with peak inflation, that inflation rates were going to come down, and that was very much powering the market overseas from the US. So we saw much of the regional areas outperforming. The US in January started to take a step back. That's very much the way that market participants thought the year was going to go. Predictably, when something starts to embed itself, it then switches over. And in February, you started to see fears come back into the market. You started to see those inflation rates that everybody thought was going to come down, they started to peak up. They started to get higher when people thought they were going to come lower. And that started to scare markets that not only were they were not going to be cutting rates at the back end of this year, but they were actually going to be keeping rates higher. So what did that do? That reversed the trend that we saw in January. That started to push the dollar higher, and that started to push US assets higher at the expense of European assets, at the expense of China and emerging markets and precious metals. So it was very much asset volatility in things that had done well in January then started to unwind in February. March was a little bit of both. March was governed by the banking crisis that unfolded in America, the banking crisis that unfolded in Europe. The perception was that these are symbolic of cracks forming in the economy when you raise rates too fast, too high. So there were a lot of investors that were saying, well, this means that the Fed needs to cut rates at the back end of the year. And that perception alone was enough to power the growth rally, the Nasdaqs of the world, very high, up to almost 20% for the quarter, which is a huge rally, very much powered by the perception that growth investing was going to come back because rates were going to come lower. As that strength came through in March, you started to see that unwind in the early starts of April, where Federal Reserve officials had to come back through and say, well, hang on, we're not done with fighting inflation. Our job is to fight inflation. So that paints a picture looking forwards of very much a market that's in wait and see mode, a market that is in will they, won't they. And that brings me back to my earlier comment about interest rate sensitivity going back to the last financial crash. Every single time the interest rate perception in the market changes, you start to see that reaction across the entirety of the market. If investors think that interest rates are going to be coming down, you start to see dollar weakness, you start to see regional outperformance from the likes of emerging markets in China. Likewise, when you see inflation starting to creep up again, you start to see people pulling in their risk. You start to see the dollar appreciating. You start to see precious metals selling off. You start to see certain areas of the market behaving in certain ways. So in a way, it's good because it's more predictable. But it doesn't mean that we've seen the end of volatility, and we expect that volatility to continue. Asset classes that we're positive about for the year, very much emerging markets. We still believe that emerging markets are at generational lows, so there's a huge opportunity there. Europe still remains attractive, although it does have its specific issues. The US market remains in quite a state of turbulence because we're not sure about the economic slowdown that's occurring there. So we're treating our investment to Europe very carefully. UK value investing, that search for dividend is extremely ripe in the UK, so that's an area to consider as well. And then for the first time in multi-decades, you've started to see bonds take up their position as a defensive element in client portfolios. Because of the torrid year that they had in 2022, there's a lot of high quality bonds on offer in the market at the moment, and investors are moving towards those in times of uncertainty. So if you see the global economy moving towards a recessionary type environment, you can expect to see investors moving more into those defensive bonds, those defensive assets. And that could be when equities are selling off. So you get that scenario where bonds provide that defensive protection, which is the first time in a very long time. But again, the overarching message is volatility is going to continue and the market remains in wait and see mode.